Hello there, baby doll. You are a slightly salted buttercup popcorn. Just one. And we are going to have a look at macro today because macro is relevant to crypto because I need you to understand that it's not scary. It's going to play out how it was always programmed. The people who try to predict macro, they end up shooting themselves in the foot. There are these big forces playing off in the background, and a lot of people who try to make big decisions based off macro, they always end up ruining themselves. Even Warren Buffett has sayings where he doesn't invest based off what he thinks the Fed is doing. The market will always shock you, I promise you that. Because if they do too much damage, they just reverse it and they print. It's very crazy when you think about it. But have a look at this. There are two important things we're going to look at. The yield curve, and we're also going to look at the unemployment rate. You know, if we start with the unemployment rate, because it's more simple, we have a look at this. So the unemployment rate is just obviously the rate of people who are still looking for a job. And they do it, and they do the surveys every month. Now, the unemployment rate right now, it is at the bottom of its range. If you look at this chart, it is an oscillator. You see, it goes up and down, up and down, up and down. It oscillates, okay? This was the zombie virus spike. You can see this. I'll move it across. You'll be able to see that with the zombie virus spike, went up to like 10 to 13%. Whenever unemployment goes up, people think it's all starting to get bad now, but they are wrong. Just like how FTX, if we go back, FTX down here was the end of the Bitcoin bear market, the crypto bear market. I want you to know that when you're looking at the unemployment rate, it is a lagging indicator. It is very lagging. Newbies will invest based off the unemployment rate. You are looking at top signals up here for the unemployment rate, which is also a bottom signal for the stock market. If you go back in history, whenever the unemployment rate starts to turn, that's when things start to go bad. So when it starts to turn, this is the inflection point. This is where things start to get really, really doozy, right? It's this part, the turning part. That's when things go from normal to panic. This is the economy part starting to shake. This is what everybody's actually worried about. And everybody always is trying to guess. You know why? Because that's where the most money is made. Most of the money is made. So when things turn, the stock market is in la-la land, and then there's vicious sharp drops down. That's this turning part here that we just drew, okay? That's that sharp turning part. So even if you go back here, 2009 was here. This was 2008. 2009 comes. This is the GFC, everything exploding, bang. Do you know what's interesting here? This is where 2009 starts. The stock market and real estate had started crashing before. And then only after they were finally done crashing, the unemployment rate goes up. But guess when the stock market bottomed? It was literally right here. This is when the stock market bottomed. Isn't that crazy? It's phenomenal when you think about it. If you go back to time and you look through newspaper clippings, if you go check Warren Buffett, you go look at all these other things, the stock market was at the bottom here, but things kept getting worse. 2009, 2010, 2011. Around here, things were getting worse. This is why a lot of people capitulated. This is why houses, the property, real estate sector, this is why they took so long to finally bottom, because things just kept getting bad on the street level. But the stock market, markets are smart. Markets price in the future. When the market started going up, right? So I know unemployment rate goes up here. The market started going up, and I can show you this on a chart. When you start seeing this information, you'll be able to view things from a different light. So you can have a look at the stock market with S&P 500, and you can see even in 2008, this is the craziest part. You go back here and you look, I just showed you this. Unemployment rate started going up here, but look, the stock market had bottomed. The stock market had bottomed. Isn't that crazy just how these things work out? That's why what I found fascinating was during the period of death and destruction, so during Bitcoin and crypto all going down to zero, during this part, everybody was looking at the unemployment rate and inflation, and everybody thought that they were predictive indicators when they were not. They're lagging. The market is always right. It's always smarter than everyone. Why? It's because there's too many scammers and insiders. The scammers and the insiders know the next move, but you don't know who they are. And whoever has the edge is always a step ahead. And guess what? The people with the edge, they change too. So me and you, we're in the middle. We're in the middle. We're in the peanut brain zone, okay? We have a little peanut brain and we're like just sitting around holding. These people in the far right, the people in the skew of the distribution with the secret edge, they might have edge for the first 1 or 2 years. But then in the third or fourth year, it moves to a new group of people. They've got insider edge about the Fed. They've got insider edge about how the government's going to spend money. And then after 2 years, the insider edge goes to, say, somebody within Russia who knows oil is going to spike. Or China, someone knows that someone's going to scam something like they did with the crypto bull market of 2021. So as you can see, the players with the most informational edge, they keep rotating over time as well, which is funny. We always go back to, if you just buy in the depression and you hold, you just keep holding, you eventually sit through the passage of time that drifts upward because they keep printing money. So what are we actually looking for? We are looking for unemployment. Unemployment's going to go up, and probably what's going to happen is if it keeps going up, people are going to see it as a victory because it means inflation's coming down. But if you go and look back in history, as you can see, whenever the unemployment rate goes, it spikes, really spikes, because this is fear. This is fear, friends. You know, there's tops and bottoms and momentum in the crypto markets, but in the macro economy, when people are getting laid off, it becomes a snowball. Because if you hear, oh, other people are laying off, it really catches on like wildfire. These things, when they start going, they start running. And obviously, once they start getting extremes, that's when the Fed, that's when those governments are like, that's it, we got to stimulate and send it the other way. So everybody's playing this game of how badly do they think we're going to turn around this time? See, everybody expects the next Great Depression. So I know this is crazy, but I won't be surprised if we get a little blip like this. See, everybody expects something huge, but what if we just kind of lay off and then go back down? That would be the contrarian view, because everybody thinks that the next Great Depression is coming. And if you really want to know why I believe this, it's because I have this theory where you see this zombie virus spike. I believe if the zombie virus never happened, we would have a next Great Depression DFC equivalent. But because we had a zombie virus, it trained everybody to be on their toes. It's almost like if you were getting into a street fight with somebody who's really tough, but 2 months before that street fight, you were walking along the street and the gang came and just started stomping you. I know you still get smashed and clobbered, but you get a bit acclimatized to it. You get used to taking the hits. You get used to being pounced on from behind and from to the side, and you're like, oh, here we go, round 2, is it? So it's funny, the market actually has this ability to learn from the past like this. And you can see it too, right? You know, from the zombie virus times, people started becoming more frugal with their spending if they needed to. People started replacing things that they didn't need, or they started finding different solutions to other ways of, say, doing fitness, eating, entertainment. Do you see how humans, we kept adapting super fast? Because we were forced to adapt super quick during these COVID times, it's possible that we don't have as much as what everyone expects for the next Great Depression, etc. Of course, we can always be wrong, friends, because anything can happen in this time. But eventually, it will swoop around, and guess what? They're going to have to turn on those money printers again. So, having said that, we've gone through the unemployment rate. We have the US yield curve. Now, the US yield curve is just the difference between long-term and short-term money borrowing, and that's all it is, okay? The Fed can affect it. That's why they want to control all that money supply, man. They don't want to go into crypto. So the chart of the US yield curve is deeply negative. I drew this red line for you because you're a baby doll baby cake. You can have a look at this. You can see this red line, and you can see how this is where the zero line is. You can see clearly how we are super negative. Now, because everybody sees this deeply negative, what they then believe is that stocks are going to crash immediately. They think, nah, we're going down to the moon, right? But this is what they don't understand. If you look at how long it takes for the bad stuff to happen, it could be making you wait quite some time, friends. I mean, look at here. This is 1998, but the recession didn't start until like 2002. This was the stock market crash. So this is the stock market crash. So you can see these. When the yield curve has gone back up, the Fed has to aggressively cut interest rates. So it's fascinating to see how long it takes. So we went down, we started inverting down, but look at this. The real damage came when it started going the other way. So just to remind you, when this yield curve has gone back up, that's the Fed cutting rates. Cut. Look at this. Fed up here. Cut. As well. Look at this. The zombie virus. Cut. Do Do you see this? So eventually, and by the way, remember, this is quite some time, friends. Could be a year. So eventually, the Fed's going to have to cut rates again. And that will be the tipsy-topsy part of the curve. And the market's going to crash. I'd like to show you this as well. If we go back, this is 1997. We had a deeply inverted yield curve. And then bang. They started cutting here. But this wasn't a full-on recession here. This was the golden zone, friends. You see this left-hand part? This was the golden zone. This is a very rare moment in history where the US Federal Reserve threaded the needle. So it was very delicate and they walked the tightrope because they were able to perfectly match and time the interest rates. So what was happening was we had the 1987 stock market crash and then we avoided a recession. I remember around this time we had a recession in Australia. But, I'm not 100% sure if America had one as well. But what you can do is you can go back and check the S&P 500. And I'll quickly put it on a monthly chart. And we can just see during this time in 1990, 1997, this was actually it. Have a look at this. So this was that 1987 crash. Everybody thought it was over. There are documentaries and movies made about the 1987 crash. But look what happened here. We actually just went up. And then we had what we call, look at this, we had an oil spike. I believe it was something to do with maybe Saddam Hussein or oil spike. But look, the stock market only went 20% down. 20% down, taps it, and then continue on. So this was like a perfect scenario when a shock came. So we're not guaranteed that they're going to be able to thread the needle and do this again. So the odds are against the central bank doing this. But remember, we have crypto now. And crypto is hypersensitive to these stimulation responses from how they operate. But on the other hand, we all know crypto needs retailers to come in and buy. So what do we do from here? We understand that everything is going to plan. Everything's going to be all right. And if things repeat, hey, we might just find out that even though there's going to be some tipsy-topsy turmoil coming along the way, we're not going to get fudded out of our bags. However, the dark curse prophecy is still potentially on the cards, friends. So even though, yes, Bitcoin has come down, I mean, if we ever get back to this part up here, if we ever get back to, say, the 85,000 mark and America, see, this is where we're going to have to just wait and see. Because if everybody in America and Australia and everybody around the world is partying, believing that they've avoided a recession deep into 2024, perhaps that's the giga bull trap. Perhaps when everybody's finally convinced there's no recession to come, then we get slaughtered in 2025 and it cuts our bull market early. That is one scenario. I'd rather us remain skeptical than try to stay up with the fairies. So these macro indicators, they are cool to look at and you get to kind of see how things are playing out. But right now, it seems that we are perfectly on track. We're going to observe these as each inflation print comes on and we're going to be waiting for something to crack in the economy because once crypto gets a sniff of any more money printing, we're going to be shooting up and hopefully pricing in the next bull market. Tell mom and dad we love them. Like, subscribe, press the belly button and all. I will catch you soon.